friends, welcome to CA Inter November 2021 revision lectures for Inter CA Financial Management. Children, we are going to pick up the topic of dividend decisions. Children, in this topic there is a debate, okay? There is a debate between two parties. One party which says that the dividend decisions matter to the value of the equity or value of the firm. The other party says your dividend decisions don't matter for the value of the equity or the value of the firm, which means this party is saying how you take this dividend decision, how much to give, how much not to give, that decision that you take, that impacts the market value of the company. This particular party says whatever dividend decision you want to take, you take. It will not matter to the market value of the company. Children, we have to study both viewpoints. Both of them have their own individual theories. As far as those who say that dividend decisions matter, first of all, we have Gordon's formula or Gordon's model. Children, Gordon's model says what? That value of equity is equal to D1 upon K minus G. D1 is the expected dividend at the end of year 1. K is the required rate of return, and growth refers to the growth rate in dividends and earnings. Children, with this model we can find out the value of equity as per Gordon. Then we have got Walter. Children, Walter says that value of equity is D plus E minus D into R by K, the whole divided by K, where D stands for dividends, E stands for earnings, that is EPS, R stands for rate of return on equity, ROE, and K stands for the required rate of return. This is the formula for Walter. Then children, we have Graham and Dodd formula. Children, this is also called as a traditional approach. Children, under traditional approach, the value of equity is to be calculated as D plus E by 3, the whole into a multiplier. Okay, the whole into a multiplier. With this we can find out the value of equity as per Graham and Dodd. Children, sometimes instead of value of equity they can give you P0, that is the actual market price of the share, and you can find out the multiplier as a balancing figure, or basically any one item is not given and you can use that formula to find out that missing link. Everybody clear? Then children, moving on, we have something called as the Lintner model. Now Lintner, children, can I say, is a person who was not so concerned about valuing equity. He only gave a formula as to how much dividend you should give in the coming year, and therefore his formula is D1 is equal to D0 plus, okay, current year EPS into the long-term target dividend payout ratio minus D0, the whole into adjustment rate. Children, using this formula he is telling you how much D1 you should give in the coming year. Of course, D0 stands for last year dividend. Current EPS is this current year earnings per share. Long-term target dividend payout ratio is the target dividend payout ratio every finance manager has in his or her head. Children, A stands for adjustment factor, which generally ranges between 0 to 1. It cannot be beyond that. Everybody clear? So numbers will be given. You have to find out the D1, or children, D1 will be given and any one missing figure you have to find out using the Lintner's model. So children, these were the different models as far as the dividend matters team is concerned. The dividend decision doesn't matter, children, consists only of one, that is Modigliani-Miller theory. Children, in MM theory I will tell you there are in all three formulas. First formula, children, is from the shareholders point of view, where it says P0 is equal to D1 plus P1 the whole upon 1 plus K. Okay, D1 plus P1 the whole upon 1 plus K. Children, D1 is expected dividend at end of year 1, P1 is expected price of the share at end of year 1, K is required rate of return, and P0 is price today. Then children, moving on to formula number 2. Formula number 2, children, is the value of the company at end of year 1. I'll write down here, value of company or firm, okay, at end of year 1, and the formula is N plus M the whole into P1. That's it, where N stands for the existing equity shares, M stands for the additional new fresh equity shares you will be issuing okay, for going for your expansion investment budget, and P1 stands for the price of the share at the end of year 1. Children, this is the formula for calculating the value of the company as a whole, the value of the firm as a whole at end of year 1. And children, third formula is value of the firm today. So I'll write down here value of firm today, okay. And children, this formula appears something like this, okay. I'll just mark this here, okay. This is NP0 is equal to N plus M into P1 minus I plus E, the whole upon 1 plus K. Children, this is the formula for calculating the value of the firm today. N stands for the number of equity shares existing. P0 stands for today's market price. So children, if you multiply this today's market price into existing number of equity shares, will give you the value of the firm today, for which this formula is given N plus M. N is existing shares, M are the new shares, P1 is the price of the share at the end of year 1, I stands for the investment expansion budget, and E stands for the earnings or the cash available in the company, and K is the required rate of return. So children, these are the three formulas as far as MM is concerned. Yes, and children, this is the end to end of what dividend decisions are. These are your formulas. Everybody clear? And of course Lintner here. And now that you have your JK classes textbook with you, I'll quickly go through the sums. Can we start, children? So the first sum, children, is based on Walter, okay. It is based on Walter. This is E, okay, E, earnings, EPS. Then they are saying this is K, okay, this is K. Now they are saying that the dividend payout ratio can either be 25% or 50% or 75%. Using Walter's formula, calculate the value of the company's equity if the R is 15%, 10% and 5%. What inference can be drawn? Children, here you have to do 9 calculations. How 9? First we'll say that, okay, if the R is 15%, then children, what will be the value of equity at these 3 levels of dividend payout? Children, if dividend payout ratio is 25%, considering the EPS to be 8, we will take the D to be 2. If dividend payout ratio is 50%, considering the EPS to be 8, the D will be 4. And if the dividend payout ratio is 75%, the D will be 6. Everybody clear? Using this Walters model, children, here you can easily calculate the value of equity, okay, at R of 15%, K of 10% for all these 3 cases. Then children, again, next, if R is 10%, again at these 3 cases, same formula, have to use 3 times and find out 3 values of equity. And then if R is 5%, do the same calculation 3 times. Like that, 9 times you have to calculate the value of equity. They're asking what inference can be drawn from the above exercise. Children, here the inference is something like this, that if R is greater than K, R is greater than K means if the company can earn a return more than shareholders' opportunity cost, then according to Walter, the share price will be maximum if the dividend payout ratio is 0%. Because there is no point in giving money to the shareholders. They can generate only K on that, but if the company keeps that money, they can generate R on that, which is greater than K, and therefore the ideal dividend payout ratio should be 0%. Everybody clear? But on the other hand, if R is less than K, company is able to generate return less than what the shareholders can generate, then children, the ideal dividend payout ratio should be 100%, at which the share price will be maximum. Everybody clear? So this was as far as question number 1 is concerned. Question number 2, again children, it's a Walter model question. They have given to you net profits. They have given to you outstanding 12% preference shares. Children, do you realize net profit? This is nothing but net profit after tax minus the preference dividend. If you do, you will get the net profit for equity shareholders. That if you divide by number of equity shares, you will get the earnings per share, that is E. Children, they have given to you R, they have given to you K. They are asking you what should be the dividend payout ratio to have the value of equity as 42. Children, using the Walters model, R is there, K is there, equity is there, and E is there. You can find out D, that is dividend per share, and then that D divided by EPS into 100 will give you the dividend payout ratio. Everyone following? So with that, we complete the discussion to question number 2. Moving on, children, to question number 3. This again, children, is Walters model. Here again they have given to you the earnings, net profits for equity shareholders. They have given to you the number of shares. Using these two, you can find out the EPS. Then children, they have also given to you the dividend payout ratio. Children, using this you can find out the D, that is DPS. So E is available, D is available, K is available, R is available. They're asking you to find value of equity using the Walters model. Then children, they're asking what is the optimum dividend payout ratio. Children, optimum dividend payout, I will say, since R is greater than K, since company can earn more than what the shareholders can earn, the optimum dividend payout ratio is 0%, and therefore the D should be 0. And at this D equal to 0, we will again calculate the value of the company share using the Walters model. Everybody clear? So this is as far as question number 3 is concerned. Question number 4. Children, question number 4 is again Walters model. Okay, question number 4 is again Walters model. Again, children, they have given to you the earnings, number of shares. Using this, you can find out the EPS. They have given to you the dividends divided by number of equity shares. You can find the D, that is DPS. P ratio is given. They're saying applying Walters model, ascertain whether the company is following an optimal dividend payout ratio. Children, do you understand here that if I do 1 upon PE, I will get K. This is one thing. If I do 1 upon PE, I'll get K. Secondly, children, can I say that here 20,000 shares into 100, which means total investment here, yes, is 20 lakhs and earnings are 2 lakhs. So children, do you realize 2 lakh upon 20 lakh into 100, you will get the R as percent. Everybody clear? And children, by comparing R with the K, you can understand according to Walter whether the dividend payout ratio should be 0 or 100. Everybody clear? Here obviously children, they are neither following 0 nor 100, because can you see, out of earnings of 2 lakh, 1 lakh 50 they are giving dividends, which means 75% is the payout, which is neither 0 nor 100. So we have to tell this is wrong. According to Walter, it should either be 0 or 100, whatever children, when you get after comparing R with K, and then understand that okay, this particular company is not following the ideal dividend payout ratio. Point number 2, what should be the P ratio at which the dividend policy will have no effect on the value of the share. Children, the dividend payout ratio will have no effect on the value of the share only when R is equal to K. We have the R here as 10%. So what will be that P at which the K will also exactly be 10%? It is nothing but 1 upon K, right? If 1 upon P is K, then 1 upon K is P. You want the K to be same as 10% R. So therefore 1 upon 10%, your P ratio should be 10 times. That is as far as question number 2 or point number 2 is concerned. Point number 3, will your decision change if the P ratio is 8 instead of 12.5? Children, if the P ratio is 8, I will get a new K. That new K I'll compare with this R, and then I will again give a new decision that yes, okay, at this comparison of new K with R, I understand that R is greater than K or R is less than K, and therefore the payout ratio should be 0 or 100%. Everybody clear till here? So with that children, we complete the discussion to question number 4. Moving on children to question number 5. This is a typical Gordon's model question. Children, Gordon's formula, I hope you remember, D1 upon K minus G will give you the value of equity. Here children, they are saying this is D0, last year dividend paid. This is the growth rate. This is G. Determine the estimated market price of the share. Children, they are saying the K is 15.5%. So children, D0 plus growth rate will give you D1. K is there, G is there. You can easily find out value of equity using Gordon. Then they are saying again find out the value of equity using Gordon. If the growth rate rises to 8%, then children, since G changes, D1 will change. Correct? Also value of equity will change. It says also calculate the value of equity if growth rate falls to 3%. So G changes, D1 changes, value of equity will change. This is what you have to do in this particular question. Calculate the value of equity using Gordon's model, D1 upon K minus G, 3 times in this entire question. Moving on children to question number 6. Children, question number 6 is again a Gordon's model. Here they are saying it has distributed current dividend of 20%. Children, they have given to the face value, 20% of it you will get the D0. They are saying the growth rate is 2%, K is 15%. D0 plus growth rate will give you D1, K is there, G is there. You can easily find out the value of equity using Gordon. This is question number 6. Children, question number 7, I will not repeat this children, using Walter and using Gordon. Same data is there children. Using that same formula of Gordon as well as Walter, you have to find out value of equity. Yes, 2 times here. One using Walter and one using Gordon. Nothing to discuss here children. Question number 7. Now children comes question number 8. Question number 8 is theory. What they are saying children, they are saying that this is your P0. Of course this is your current face value, but the shares are quoted at par. So this becomes your P0. It proposes to declare a dividend of 10. This becomes your D1, and they are saying that the K is 12%. Correct? The K is 12%. They are asking what will be P1. Everybody following? What will be the market price per share if dividend is not declared, if dividend is declared? For that, children, you have to use this formula here, this one, okay, where children P0 is there, then we have D1 and we have KE. You have to find out P1. If dividend is not declared, then the D1 will be 0. If dividend is declared, then children, can I say the D1 will be 10. You have to find P1 as the balancing figure. Everybody got it? So moving on, children, next point number 3, they are saying assuming that the company pays the dividend, okay, and has net profits of 5 lakhs and also makes new investments of 10 lakh during the period, how many new shares must be issued? Children, for this what you will do, see, you want to make investments of 10 lakh, right? Now you have net profits of 5 lakh, but children, since you are paying the dividend, how much dividend you are paying? Children, do you realize 10 lakh is the total capital divided by 100, which means, children, do you realize 10,000 shares are there? 10,000 shares, children, multiplied by 10 rupees per share, total 1 lakh rupees dividend you are giving. Everybody clear? 1 lakh rupees dividend if you are giving out of 5 lakhs, which means to satisfy your investment budget of 10 lakhs, only 4 lakh reserves you have, which means for 10 lakhs, 4 lakh you have, which means balance new equity you have to issue worth 6 lakh. Everybody clear? So 6 lakh rupees equity we will have to issue. At what price, children? At P1. Which P1? The P1 we have already calculated in point number 2, that if dividends are declared, then what will be P1 we already have. So children, total equity to be issued divided by the issue price per share will give you the number of equity shares that must be issued for question number 8. Everybody clear? So that is the discussion for question number 8. Moving on, children, to question number 9. They are saying here in question number 9 that the KE is 10%. It has 25,000 shares and current market price, children, this is P0. It expects a net profit of 2,50,000. Children, these are your earnings or the cash available, and the board is considering a D1 of 5. M Limited requires to raise 5 lakh for an approved investment expenditure. Children, this is your I. Show how MM approach affects the value of M Limited if dividends are paid or not paid. First of all, children, what you should do? If dividends are paid, then calculate P1. Okay, calculate P1 using this formula. Everyone clear? Because D1 you have, K you have, P0 have, you can easily find out P1. Then again calculate P1 if dividends are not paid. Okay, if dividends are not paid, again calculate the P1. So now 2 P1s you have, correct? You have the 2 P1s. Now what you should do, they are asking you how the value of M Limited will not be affected. Show as per MM approach whether dividends are paid or not paid. For that, children, what you should do is, I'll just show it to you. What you should do is simply calculate this particular formula NP0. Put the numbers here 2 times. One is when dividends are paid and second is when dividends are not paid. Everybody clear? Now children, for that you will require a working note. I'll tell you what working note you will require. First of all, children, I and E. What is I and E? Can I say I here is 5 lakh, E here is 2,50,000, irrespective of whether you are giving dividends or not. KE, children, you have already with you as your 10% required rate of return. So now what is N plus M the whole into P1? Children, N are your existing equity shares. So existing equity shares, children, you have are 25,000, that you know. But children, can I say now your M and your P1, these are the only 2 items. Okay, I'll just remove the markings. These are the only 2 items, children, which will differ if you give dividends or don't give dividends. So children, if I give dividend, then we'll have to find out how many new shares are to be issued as per what I just discussed with you in question number 8 here. Find out how many new equity shares are to be issued if you give dividends. And children, you already have a P1 for that. You can put all the numbers here. That new shares you will be issuing, children, become the M. P1 you have, you will get the NP0 if dividends are issued. If dividends are not issued, again make that note, children, again make that working note which I was talking about, where you will have to again find out how many new shares are to be issued. That will be your M. You already have the P1 in this case. If dividends are not issued, take that M, take that P1, put it in this formula and again calculate NP0. You will find that NP0 for both the options, whether dividends are paid or not paid, will comes same. The dividend policy has not impacted the value of the firm. Everybody clear? See children, one thing you should understand here, whether you pay dividends or not pay dividends, children, do you therefore understand here? I'll just remove this marking here. Do you understand whether dividends are paid or not paid? This N, this I, this E and K, everything remains same only. What will be affected is number of shares new to be issued and the market price of the share at the end of year 1, for which the working notes you will have to make. First of all, you will have to calculate P1 children, because unless you calculate P1 you cannot find out the new equity shares to be issued. So first calculate P1 for both cases, then calculate the number of equity shares, new number of equity shares M that we have to issue to satisfy our investment budget. That M you find out, and once you have that, simply put the numbers in this formula here. You will get the NP0 same for both cases. That is what was there as far as question number 9 was concerned. Question number 10 children now is based on Graham and Dodd, that is traditional approach model. Here children, I will show you that formula. This is that formula, right? P0 or value of equity is equal to D plus E by 3 into M. Children, here they have given to you the P0, they have given to you the D, they have given to you the M. They are asking you to find the E. Put the numbers in the Graham and Dodd model. We'll find the E as the balancing figure. This was as far as question number 10 is concerned. Question number 11. Children, in question 11, again it is a Graham and Dodd question. They have given to you the dividend payout ratio as 40%, which means children, can I say D is equal to 0.4 E, correct? 40% of E is D. If the company follows traditional approach, which means Graham and Dodd model, and the multiplier is 9, what will be the P ratio? Children, we know the formula is that P0 is equal to D plus E by 3, the whole into M. Now children, we know that instead of D we can write down 0.4 E, correct? Instead of D we can write 0.4 E. Children, here the multiplier given to us is 9. You have to simply open this up and find out P0 by E. Everybody clear? P0 by E. If you can see here carefully children, you have all the numbers here. You can just open this up, and of course at the end you will be left with P0 by E. Children, P0 by E is nothing but MPS by EPS. You will be getting some value here, and MPS by EPS is exactly what is the P ratio. Everyone clear? Very simple. Just put the numbers and open up this bracket. With that children, we complete the discussion to question number 11. The next one children, question number 12, the last question, is based on Lintner's model. I will show you that particular formula of Lintner. This is the formula of Lintner children. Here they have given to you D0, they have given to you the adjustment rate, they have given to you the long-term target dividend payout ratio, they have given to you the current year EPS. They are asking you to find D1. Everybody clear? All numbers are there children. Can you see D0 is there, current EPS is there, long-term dividend payout ratio is there, D0 of course is there, adjustment factor is there. They are asking you to find D1 using this formula. Everyone clear? So that is Lintner's model. With that children, we complete the quick revision of the entire chapter of dividend decisions. Okay friends, so now that you have completed the entire revision of this chapter of dividend decisions, children, I just want to discuss one more question with all of you. That is from your new study module of ICAI for this chapter of dividend decisions, practical problem number 6. Children, this question is also belonging to Gordon's model application only. Gordon's formula you know, right? V bracket E is equal to D1 upon KE minus G, where we discount all the future cash inflows at the rate KE, where these cash inflows are growing at a constant rate G. Based on the Gordon's model only, this practical problem 6 is there, but it is slightly one step higher. Okay children, one step higher, because this question is based on something called as multi-step growth model. Okay, multi-step growth model. Children, this concept of multi-step growth model is something that I need to teach it to you first before we start understanding this question, before we start solving this question. So children, please patiently listen to my explanation to multi-step growth model. Children, this explanation is very crucial for you to understand before you take up this question. So patiently listen to the entire thing, and then we will solve this question also for you. Children, all the best. The video is starting now. Hi friends, so welcome to a new module, Gordon's formula multi-step model, okay, multi-step growth model. Students, in this module, before I start explaining to you what is that multi-step growth model in Gordon's formula, one video I want to teach you here. This video I have named as why no selling price in the valuation model, which means why we don't take the future selling price in valuation. I'll tell you what I mean. Students, when I say Gordon's formula, what is the formula value of equity? Tell me. The formula value of equity is D1 upon KE minus G, correct? Value of equity is equal to D1 upon KE minus G. Mathematically, can I say value of equity is equal to present value of all future dividends, that is D1 plus D2 plus D3 plus D4 plus D infinity. Everyone agrees with this? So the value of the equity, this formula captures this entire stream. Everybody following till here? Now students, let's say there is a person. This person wishes to buy the share today. He's saying today he will buy the share. He will enjoy dividends for 1 year. He will enjoy dividend for second year. He will enjoy dividend for third year. At the end of third year, he will sell off the share at P3. What is P3? P3 is price of the share at the end of year 3. Correct? So this guy is now saying that for me, the future cash inflows are not D1 to D eternity. They are just D1, D2, D3 and P3. Nothing else. D1, D2, D3 and P3. Are you listening? So therefore he says that for me, the theoretical value of this equity share should be, considering the fact that I'm clear, I've got a 3-year horizon in front of me. In 3 years, I'm going to exit the share. Therefore, for him, the future cash inflows are only D1, D2, D3 and P3. So he says for me the present value of D1 plus D2 plus D3 plus P3 is the value of equity. But Gordon is saying no, the value of equity should be present value of D1 to D eternity. Everybody following? So students, who is right and who is wrong? Now can I say this person here is now shouting, for me D4 to D eternity, why should I take into valuation? Why should I be ready to pay for that? What I'm not going to get only, I'm going to only get D1, D2, D3 and P3, right? Why should I pay for D4 to D eternity when I'll be stopping at D3? Everybody clear? Now students, what you have to understand is, why did Gordon not take into account this price, this selling price into picture? Why he took dividends till eternity and ignored the selling price? That is what we have to study. Can I start? Now listen to me carefully. One school of thought says that the reason why Gordon didn't take price into picture is something like this. Everyone focus hard. A very important example I'm going to explain. Ready? Let's say there is a share. Okay, are you listening? Let's say there is a share. The D1 of this share is 5, which means expected dividend of this share at end of year 1 is 5. Growth rate expected in these dividends is 6% per annum, okay? Growth rate expected in dividends is 6%. Now children, listen carefully to what I'm saying. The whole world has a required return of 16% from this share on an average. Are you listening? The whole world has a required return expected from this share of 16%. Now children, let's calculate the value of equity from the whole world's point of view. Students, do you realize that the value of equity from the whole world's point of view will be same, D1 upon KE minus G. D1 will be 5. KE will be the world's KE, that is 16%, minus G, that is 6%. We will get rupees 50. What is the meaning of rupees 50? The whole world is ready to max pay rupees 50 for this share. Are you listening? The whole world is ready to max pay rupees 50 for this share. And therefore, do you realize the actual price of the share also will be rupees 50 only, right? Because if the whole world is ready to max pay 50, the share price cannot trade at 60, 70. Nobody will buy. It has to be 50. The share price cannot be 40, 30. The whole world will start buying. Demand will increase. Price will again touch 50, which means what the whole world wants is reality, is the theme. Everybody understood? What the whole world wants becomes actual price, correct? Nothing to debate here. So if the whole world wants 16% return and therefore the whole world says it is ready to max pay rupees 50 for this share, therefore the actual price of the share and the theoretical price will be same. Everybody clear till here? Great. Now students, let's say there is an investor. Please pay attention, okay? Let's say there is an investor who owns this share. Are you listening? He owns this share today. And he is now planning to sell the share today itself. I'll again repeat, there is an individual investor. This guy already owns this share, okay? And he is now planning to sell off this share. Because he's planning to sell off the share today, the price he will get is rupees 50, correct? So I'll write down here, case 1. Please pay attention. Share to be sold today. That is end of year 0. I hope you're listening. Share to be sold today, that is end of year 0. In this, let us calculate the present value of cash inflow for that investor when he sells off the share. Can we start? So here, cash inflow, discounting factor at the rate 16%, present value. Children, tell me, when is he selling the share? He's selling the share today. That means end of year 0. So I'll write down end of year 0. What is the future cash inflow that he will get? Future means what? Today only is getting, how much is getting? 50 rupees. So for him the cash inflow is 50. Discounting factor obviously will be 1 because it is the end of year 0. The present value also will be 50. Which means if case 1 happens, if he is ready to sell the share today only, the present value of cash inflows will be rupees 50. Till your story is clear, let's now go ahead. Students, I will now show to you case 2. Listen carefully, okay? Case 2. Share to be sold at end of year 1 and not today. So if this investor is planning to sell this same share after 1 year, what will be his present value of cash inflows? Let's check. So PV of CI, year, cash inflow, discounting factor at the rate 16% and present value. Now do you realize, children, the year which I will be writing is not 0 but it will be 1 and 1. What does that mean, sir? 1 and 1. Children, do you realize if he is planning to sell the share after a year, then he will not only be getting this dividend of 5, but also he will be getting the price at the end of year 1. Everybody following? So 2 cash flows he will be now entitled to. One is D1 at the end of year 1 and the second is the price at the end of year 1, which I will give name as P1. P1 refers to price at the end of year 1. Everybody following? So I'll write down here 5 rupees D1 he will get, but how much P1 he will get, that I don't know. Discounting factor and present value. Can we start understanding? Now the only thing we need to understand is P1. Ready? Children, do you realize that when you calculated D1 upon KE minus G, you remember you got value of equity? Value of equity, students, can I also say it is nothing but theoretical value of the today. Hence I write P0. P0 means what? Price at the end of year 0. Therefore, listen to this extremely carefully. This is 0, 1, 2, 3, 4, eternity. D1, D2, D3, D4, dot, 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 D eternity. Now children, do you realize if I do D1 upon KE minus G, it gives me the present value of all these dividends starting from D1 to D eternity as on end of year 0, it gives me P0. Everybody following? So D1 upon KE minus G is P0. What that means? Mathematically speaking, D1 upon KE minus G is the present value of all future cash inflows from D1 to D eternity discounted as on end of year 0. And financially speaking, D1 upon KE minus G is what I am ready to max pay at end of year 0 for future cash inflows, that is D1 to D eternity. Everybody understands till here? Now children, if P0 is equal to D1 upon KE minus G, Tell me what will be P1 equal to. Obviously P1 will be equal to D2 upon Ke minus G. Everybody clear? Now mathematically speaking, what is this? Can I say D2 upon Ke minus G will obviously be capturing the present values of all future cash inflows starting from D2 to D eternity. I hope you understand. D1 upon Ke minus G captured everything from D1 to D eternity. D2 upon Ke minus G will capture everything from D2 to D eternity. And the most important point is it will give you the present value as on end of year 1, not end of year 0, correct? It takes the present value. So if D1 to D eternity gave you the present value at P0 end of year 0, D2 to D eternity will give you the present value at end of year 1, and that is the price 1. Everybody following? So mathematically speaking, this formula captures the present value of all future cash inflows starting from D2 to D eternity, discounted as at end of year 1. And financially speaking, this formula tells me how much I am ready to max pay at the end of year 1 for all future cash inflows from there, that is D2 to D eternity. Everybody clear? So therefore, if I want to find P1, that is what is the price at the end of year 1. That is what the whole world is ready to max pay for that share at end of year 1. Then the formula cannot be D1 upon Ke minus G, because at the end of year 1, I will be ready to max pay for the future cash flows from year 1 onwards, correct? That is D2 onwards. I hope you are understanding. Hence the formula will be P1 equal to future from there, D2 to D eternity. The formula is D2 upon Ke minus G. Everybody clear with this? So students, coming back, tell me, I need P1, right? What is the formula of P1? D2 upon Ke minus G. Now children, how do I find D2? They have given to us D1, right? D1 is available, G is available. Add the G to the D1, you will find D2. So can I say that 5 plus 6% is 5.3. So students, D2 therefore is 5.3 divided by Ke minus G will give me 53. I will write 53 here. Let's now discount and see what happens. Now considering that both are same years, same discounting I will use. So I'll do 53 plus 5 divided by 1.16. I exactly get the present value as 50. Everybody clear with this? If you want the breakup, students, it is 5 divided by 1.16. This is 4.3, and this is 53 divided by 1.16. This is 45.7. Everybody clear with this? Let's now go ahead. Students, one thing you should notice, in case 1 also the PV was 50. In case 2 also the PV is 50. Let's now take one more case, case 3. I hope you are listening. Case 3, share to be sold, let's say at end of year 3. Share to be sold at end of year 3. So if that happens, calculation of PV of CI let's do. So here CI DF at the rate 16% and present value. Can we start? Now students, what all cash inflows I'll get if I'm selling the share 3 years from now? I'll get dividend at end of year 1, I'll get dividend at end of year 2, I'll get dividend at end of year 3, I will get price at the end of year 3. Everybody following? 3-year dividends I'll get and price at the end of year 3. Now students, as far as dividend of year 1 is concerned, we know it is 5. As far as dividend of year 2 is concerned, it will be 5 plus 6%, as we saw earlier, 5.3. As far as dividend of year 3 is concerned, I will do 5.3 plus 6%, that will give me 5.618 and so on. Now we need to find P3. I hope you understand. So the price I will get at the end of year 3, P3 will be D4 upon Ke minus G. D4 will be 5.618 plus 6%, that is 5.955, divided by 16% minus 6%, that is if I divide by 10%, I get the P3 as 59.55. Everybody clear? Let us now find the present value. Students, 5 divided by 1.16 equal to M plus, we get 4.31. 5.3 divided by 1.16 equal to M plus, we get 3.94. 5.618 plus 59.55 divided by 1.16 equal to M plus, this is 41.75. MRC comes to 50 rupees. Everybody following? Rounded off to 50. Everybody clear with this? Yes. And therefore we realize that whether I sell the share today, okay, whether I sell the share today or I sell the share after 1 year, or I sell the share after 3 years, or I sell the share after eternity, the present value is going to be 50 only. So Gordon is saying, why you are wanting to take the price into consideration? Straight away my formula is also giving 50 only, correct? You are saying, okay, my present value is only P0. Okay, 50. My present value is D1 plus P1. Okay, 50. My present value is D1, D2, D3 and P3. The present value of all this is also coming to 50. Gordon is saying, why so much effort you are putting? Straight away use my formula. Directly 50 rupees you will get. Everybody clear? Now we are confused. We might say, sir, Gordon's formula does present value of D1, D2, D3 till eternity. And in case 3 we saw D1, D2, D3 and P3. But both of them are giving 50 rupees answer. How? Gordon has ignored P3, no? He has taken everything from D1 to D eternity. He has ignored P3. How then both are giving same answers? Students, I am very sure some of you have understood. Students, both of them are same. Nothing is different. I'll tell you how. See, please pay attention. What is Gordon saying? Gordon is saying that present value of D1, D2, D3, D4, D5, D eternity, correct? And the investor who is wanting to be in that particular share for a period of 3 years only, he is saying that PV should be of D1 plus D2 plus D3 plus P3, correct? He is not wanting to go for D4 to D eternity. Now students, what am I saying to both of them? Stop fighting, both of you are same, because P3 is nothing but D4 to D eternity, correct? P3 is the present value as on end of year 3 of D4 to D eternity. So instead of D4 to D eternity, I am writing P3 at end of year 3 along with D3. Everybody following? So I have got D3 already, D4 to D eternity. Instead of that, I am writing P3. Value is same because P3 is nothing but present value of all future cash inflows starting from D4 to D eternity as on end of year 3, which we call as P3. Both are same. One is saying D1, D2, D3, D4, D5, D6 till D eternity. Other is saying D1, D2, D3 and then D4 to D eternity is clubbed in one capsule called P3 at end of year 3. Both will definitely give you the same values only, correct? So therefore both of them gave us 50, and therefore don't think that Gordon has ignored the selling price. He has not ignored. He has in fact expanded the selling price to all future dividends from there till eternity, because he knows that the selling price of that share at whichever year you want to take is nothing but the present value as on that year of all future cash inflows from that year onwards till eternity. Everybody following? Therefore students, Gordon's formula is perfect. Don't worry about the price. It is already embedded in that formula, correct? Now one last thing I will tell you students. See, you can also see it something like this, that Gordon is saying that value of equity is present value of D1, D2, D3, D4, D5, D6 and D eternity, correct? Now you might say, sir, we are going to enjoy only 3 years dividends, correct? Why should I pay for eternity? I'll give you simple understanding. Gordon is saying what you are ready to max pay today should be the present value of all future cash inflows that the instrument is offering to you, not what you are enjoying from the instrument. What the instrument is offering to you becomes the value of that instrument. Everybody following? Just as you go to a coaching class, you say what is the fees? The coaching class admin says the fees is 1 lakh rupees, and in 1 lakh rupees you will be attending 20 sessions. Now you might say, you know what, we are going to attend only 4 sessions because 16 sessions I will be out of the country. The coaching class is not going to now price the fees for you only for 4 sessions, because the coaching class is saying that we will be offering you 20 sessions. Now you are enjoying only 4 sessions is your problem, and therefore the value of the product you will be buying from the coaching class will obviously be for the 20 full sessions. Everybody clear? Similarly, if I go to the equity share and I say, equity share, I am going to only stay in you for 3 years, I will therefore pay for you only for 3 years. That is wrong, because you have to pay what the equity share is offering to you. You don't live till infinity is your problem, correct? You are going out in 3 years, that is your problem. But the share's valuation will obviously be on the basis of the future cash inflows from the share, not what you are enjoying. I hope you understand. We are valuing the share. I hope you understood, right? Now I will tell you one more thing. Students, therefore, it won't be only present value of D1, D2 and D3. It will be present value of D1 to D eternity, compulsory. And therefore, when I say that you add P3 here, do you realize everything is taken into consideration? Yes. So the whole thing is so beautiful like this. Today, you pay for D1 to D eternity. Forget the P3. You pay for D1 to D eternity, correct? So, now that you are entitled to receive and enjoy D1, D2, D3 till D eternity because you have paid for the entire stream. Let's say year 1 happens, you enjoy your D1. Year 2 happens, you enjoy your D2. Year 3 happens, you enjoy your D3. But at the end of year 3, you say, I want to quit. No problem, quit. But you will say, sir, but I have paid for D1 to D eternity. No, I have enjoyed only 3 years dividends. I will say, don't worry. You are selling off the share, right? When you sell off the share, you will be receiving P3 also, right? And what is P3? Someone who is buying the share from you is paying P3 to you, which means that someone is paying to you the present value of D4 to D eternity to you at end of year 3. Did you understand? So you paid for 1 to eternity, you enjoyed 1, you enjoyed 2, you enjoyed 3 dividends, and then 4 to eternity that you are not enjoying. Can I say you are recovering from the person who will enjoy that? That is this person who is now buying the share from you at end of year 3 at P3. So basically you paid for 1 to eternity, you enjoyed 1, 2 and 3, and then you recovered your 4 to eternity by selling your share at end of year 3 for P3. Basically you ended up paying only for 1, 2 and 3 only. I hope you are understanding. But when you are valuing the share, you cannot say I will only pay for 3. You have to pay for the entire thing. Then you enjoy 3 and then sell off the remaining part, recover your investment, recover the value that you paid for 4 to eternity. Thereby eventual result is you have paid for 3 years only. Everybody clear? So with this I just wanted to tell you that don't think that Gordon got it wrong by not involving price of the share at which the investor is expected to sell. He's saying don't worry about the price. Whenever you want to pay, no problem. Take this valuation only. Basically children, take this formula only. This formula includes everything. Don't worry. Because even if you want to sell it in a future date, that P7, let's say you want to sell in the year 7, end of year 7. P7, what will be P7? P7 is the price at the end of year 7. P7 is what I am ready to max pay at the end of year 7 for future cash inflow starting from D8 to D eternity. So mathematically P7 is nothing but the present value at end of year 7 of D8 to D eternity. Basically D1 to D eternity takes care of all the future prices also. Everybody clear? Yes, this P3 is expanded into D4 to D eternity. Everything is taken into picture, and that is why I hope you understood both these models will give you the same answer of valuation 50 and 50. Yes. So students, with that I end this video of why selling price is not taken in Gordon's formula. It is not that it is not taken. It is there. It is there, however, in an expanded form of future dividends from there. Yes. So now let us finally start what is relevant from exam point of view. That is the multi-step growth model. Students, multi-step growth model, again Gordon's formula only you have to use, but something different is there here. I'll take an example to explain the thing to you. Okay, see, let's say there is a share, okay, whose D0 is 100. What is the meaning of D0? D0 means dividend last paid, correct? Last year end means yesterday we received that dividend, correct? End of year 0 we are sitting, beginning of year 1 we are sitting. End of year 0 the dividend that we received is the last year dividend, that is D0. Students, let's say the question tells you that your KE is 12%, okay? The question tells you the KE is 12%. And now they say that growth rate, now generally students growth rate they give you one rate which is constant, correct? But now it's multi-step growth. Let's see how it happens, okay? Growth rate they say is 15% for first 2 years, okay? Then they say it is 11% for next, let's say 3 years, and then they say 7% constant thereafter, okay, 7% constant thereafter. So now can you see that they are not giving you a growth rate which is constant from year 1 only for eternity, they are giving you a multi-step growth model. Everybody following? Now in such a case, students, how do you solve this? My first question to you is, can you use this formula? Value of equity is equal to D1 upon KE minus G. Value of equity means here theoretically speaking P0. Can the theoretical P0 equal to D1 upon KE minus G formula be used? No. Why can't we use it? We can't use it because for this particular formula, the growth rate has to be constant from year 1. I hope you understand. If the growth rate is not constant, then one of the most important assumptions of this Gordon's formula crashes, and that assumption crashes, the formula crashes. You cannot use that formula. I am very sure you are understanding what I am trying to explain. So therefore, children, in such a case, what to do? How can we value the share? Now, can I tell you that valuation of a share is nothing but the present value of future cash inflows, correct? The Gordon's formula was anyways used because the cash flows were for eternity. To get the present value of them, we needed a model, and Gordon gave us that model. But Gordon's formula works only when the G is constant. When the G is not constant, I am very sure you understand you cannot use Gordon's formula, right? You cannot use Gordon's formula straight away, but you can use Gordon's formula someday. Someday, once the growth rate becomes constant. Are you listening to me? Now look at this question. They are saying last dividend is D0, that is 100. KE is 12%. They say that we know the growth rate is not going to be constant. We say, okay, tell us what is the growth rate. They say for the first 2 years now coming, the growth rate will be 15%. We say, okay. Then next 3, 4, 5, 6. They say no, next 3 years, after 2 years, the growth rate will be 11%. I say okay. Next, they say beyond that we can't see. So if beyond that you can't see, if your vision is only for a 5-year period, then beyond that you will have to assume growth rate to be constant. Otherwise, how can you value a share? You will have to take Gordon's help, and to take Gordon's help, we need the G to be constant. Everybody following? So therefore, they say yes, the growth rate will become constant. Thereafter means what? 6th year onwards. I hope you are listening. So do you realize, children, that since the growth rate is not constant from year 1 onwards, D1 to D eternity I cannot club in Gordon's formula. But once the growth becomes constant, that is year 6 onwards, do you have the intelligence to understand that D6 to D eternity can be clubbed in Gordon's formula? P5 is equal to D6 upon KE minus G. I'll repeat, P5 is equal to D6 upon KE minus G. Are you understanding? Students, do you realize that this formula captures the present value of all future cash inflow starting from end of year 6, D6 to D eternity, discounted at the end of year 5, that is P5. Everybody following? So students, can I say Gordon's formula we will use, but once G becomes constant. But G is becoming constant from year 6 onwards. So D6 to D eternity has now been clubbed in Gordon's formula. What about the other 5 dividends, D1, D2, D3, D4 and D5? Oh, they will have to be discounted separately. Everybody following? We will have to calculate present value. See, present value means value today. We will have to calculate today's value, means for today, the future cash inflows don't start at D6. Future cash inflows start at D1 onwards. D1, D2, D3 till D eternity. All future cash inflows, present value is P0. But I can't use D1 upon KE minus G Gordon's formula straight away with D1 because the growth rate is not constant for the first few years. No problem. All those years when the growth rate is not not constant, they are dividends, do the discounting separately. Okay, and once the Gordon's formula can be applied, that is once the growth rate becomes constant, then one shot you discount them using Gordon's formula. Everybody following? So can I say in this particular case, value of equity can be written as present value of D1 plus D2 plus D3 plus D4 plus D5 plus P5. In fact, I can write this plus P5. Everybody following? So students, with that we get the Gordon's formula also in place once the growth rate becomes constant. And now these first 5-year dividends, when the growth rate was not constant, we will be discounting them separately. So simple. And as far as D6 to D eternity is concerned, D6 to D eternity, children, I am very sure you understand, is now clubbed in P5. Yes, it is clubbed in P5. Everybody following? Let's now see how to do the calculations. Please pay attention. Here, cash inflow, discounting factor at the rate 12%, okay, and present value. Some of you might say, sir, Gordon's formula is being used. Here the KE is 12%, G is 15%. KE is less than G. Another assumption is being violated. No, children. Do you realize that when the G is 15% or 11%, the Gordon's formula is not being used only. Gordon's formula is being used when the growth rate is 7, right? And at 7, can I say G is less than KE? KE is greater than G. Gordon's formula can apply, correct? Let's now go ahead. Tell me what will I write in here? I'll write 1 for D1, 2 for D2, 3 for D3, 4 for D4, 5 for D5 and 5 for P5. Everybody following? Let's now put the numbers. So my D0 students is 100. Yes. So 100 plus now 15% for first 2 years. 15% will give me 115. Plus 15% will give me 132.25. Then next is 11%. So for 3 years, okay, don't forget, plus 11% is 146.8, plus 11% that is 162.9, plus 11% that is 180.9. And now that we have got our D5, let us find P5. I hope you remember how to do it. In the last video I have shown you, right? What is the formula for P5? D6 upon KE minus G. Students, what will be D6? It will be 180.9, that is D5, plus how much growth rate? 7%. Everybody following? Growth rate of 7%, which is constant thereafter till eternity. So I will take 180.9 plus 7% divided by K minus G. Everybody clear? And this G obviously will be the constant G which I'll be using in the formula, and here can you see K is greater than G. So students, on our calcs, 180.9 plus 7% divided by, can I say, 5%. So I will get 3871.26. I will write down here 3871.26. And let us now do the discounting. We'll find out the value of equity. Can we start? 115 divided by 1.12 equal to m plus this value. 132.25 divided by 1.12 equal to m plus this value. 146.8 divided by 1.12 123 m plus this value. 162.9 divided by 1.12 1234 m plus this value. And then 180.9 plus 3871.26. Both are for 5 years. So divide by 1.12 12345 m plus this entire value, MRC, will give us 2715.43. 2715.43 is what, children? It is nothing but the present value of all future cash inflows from D1 to D eternity, and this therefore becomes my value of equity. Everybody following? This becomes my value of equity. This is what I am ready to max pay for this share today. Everybody clear? So tell me, students, if growth becomes constant, okay, from year 6, can I say stop at P5? I hope you understood. Tomorrow in the question they say growth becomes constant from year 11, then you should stop at P10. If growth becomes constant from year 7, you should stop at P6. If growth becomes constant from year 1, then of course you should stop at P0 only. There is no need to do any table. Straight away P0 equal to D1 upon KE minus G. Everybody clear? Now students, one thing you should understand is the meaning. Please pay attention, okay? Now I will remove these numbers and I want to tell you something very important. See, I'll take the first number now, the first dividend 115, and I'll find the discounted value. 115 divided by 1.12 will give me 102.68. Children, what is the meaning of this? 102.68 means what I am ready to max pay today for the cash inflow I am expected to receive after 1 year, that is 115. That means the 115 that the share is expected to offer me in a year's time, for that 115 today I am ready to max pay 102.68. Clear with this? Now let us take 132.25. Present value of 132.25 will be 132.25 divided by 1.12 pressed equal to 2 times. I get 105.43. What is the meaning of this? 105.43 is what I am ready to max pay today. 132.25 rupees I'm going to get in 2 years from today. Everybody following? So the share is expected to give me 132.25 rupees in 2 years time. For that, today I'm ready to max pay 105.43. Like that, students, if I discount 146.8, I'll get what I'm ready to max pay today for 146.8 I'm expected to receive in 3 years time. If I discount 162.9, today's value is nothing but what I am ready to max pay today for 162.9 rupees I'm expected to receive in 4 years time. If 180 I discount for 5 years separately, this is what I'm ready to max pay today for 180.9 I'm expected to receive in 5 years time. Now children, listen carefully. What is 3871.26? Be very clear about this. 3871.26 is present value. Yes, it is present value. Then why are we doing present value again of the present value? Listen carefully. 3871.26 is the present value as on end of year 5. I am very sure you have understood. 3871.26 is the present value of future cash inflow at end of year 5. D6 to D eternity's present value is 3871.26, but at the end of year 5. If I want to know the today's present value, we will have to discount it again for 5 years. Everybody following? Financial interpretation of this is what? At the end of year 5, I am ready to max pay 3871.26 for D6 to D eternity. I'll again repeat, at the end of year 5, if I go to purchase the share, I will purchase the share for the future cash flow starting from D6 to D eternity, correct? For D6 to D eternity, I am ready to max pay 3871.26 at end of year 5. Okay, and if I now calculate the present value of this, 3871.26 divided by 1.12, 1, 2, 3, 4, 5 if I do, I get 2196.66. Students, what is 2196.66? This is what I am ready to max pay today for D6 to D eternity combined. Everybody following? So for D6 to D eternity total, I am ready to max pay 3871.26 at the end of year 5. But for that same D6 to D eternity, I am ready to max pay 2196.66 today, which means the present value of 3871, if I take that is discounted for 5 years, I get 2196. This is nothing but the present value of D6 to D eternity only, but as on today. Everybody clear? Therefore, this entire chunk becomes what I am ready to max pay today for D1, for D2, for D3, for D4, for D5 and for D6 to D eternity one shot. Everybody following? Therefore, this value 2715.43 is what I am ready to max pay today for D1 to D eternity. Everybody clear? So with this, students, I end my explanation of how to do multi-step growth model. Just check when is the growth becoming constant. If the growth is becoming constant from year 6, then stop at P5. Stop at P5 means your year column will be 1, 2, 3, 4, 5, 5. Which means it will be D5 and P5. Everybody following? If the growth rate is becoming constant from year 11, then stop at P10. P10 means 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 10. Why 10, 10? Last two numbers, it will be D10 and P10. P10 will be nothing but D11 upon KE minus G. It will capture everything from D11 to D eternity at end of year 10. Everybody following? So with that, students, I end my explanation. Okay friends, I hope you all enjoyed the entire explanation. That explanation, children, was from CA final, but I hope you understood it all. Now children, with that background, let us read this question number 6, this practical problem 6. I request everyone to first of all pause the video and read the question carefully. Start. Okay students, I hope you all have read the question. Let us now try to understand it. They are saying A&R Limited is a large cap multinational company listed in BSE in India with a face value of rupees 100 per share. The company is expected to grow at the rate 15% per annum for next 4 years only, and then 5% for an indefinite period, which means, children, do you realize that the growth rate will become constant from year 5 onwards, and therefore do you realize you have to stop at year 4? In your table you will be writing year 1, 2, 3, 4, 4, where the first 4 dividends D1, D2, D3 and D4 will take separately, and then D5 to D eternity will club in P4, because there we can use the Gordon's model once the growth rate becomes constant. They are saying the shareholders expect a 20% return on their share investments. Children, this will become their KE, minimum required rate of return. The company paid rupees 120 as dividend per share for the financial year 2021. This becomes their D0, the last dividend. The shares of the company are traded at an average price of rupees 3122 on the last day. Find out the intrinsic value of the share and state whether shares are overpriced or underpriced. So children, what you have to do is we have to simply calculate the value of equity as per the multi-step growth model. That value of equity, children, is the theoretical value, the intrinsic value, the value that I am ready to max pay for this share, and then that value, children, will compare with the actual price. If the actual price is more than what I am ready to max pay for the share, we will say it is overvalued and reject it. However, if the actual price 3122 is less than the theoretical value, less than the value that I want to max pay, we will say undervalued and purchase it. Are you ready, children? Let's start. So I'll write down here for you practical problem 6. Okay, practical problem 6. In that I'll write down calculation of value of equity. Okay, calculation of value of equity. Children, we know that value of equity is nothing but the present value of all future cash inflows from the share. Okay, calculation of present value of all future cash inflows from the share, for which we will calculate the PV of CI. So children, I will write down here PV of CI, that is value of equity. Okay, 4 columns will make year, cash inflow, discounting factor at the rate. What is your required rate of return, children? Your required rate of return is 20%. So discounting factor at the rate 20% and present value. Okay, and present value. In here, children will write down 1, 2, 3, 4, 4. Everybody clear? 1, 2, 3, 4, 4. Now children, what was your D0? Last year dividend given to you is 120. Let us take 120 on the calci. Now children, they are saying that this dividend of 120 is expected to grow at the rate 15% per annum for the next 4 years. Okay, 15% per annum for the next 4 years. So children, 120 plus 15%, 138 will be D1, plus 15%, 158.7. okay, 158.7 will be D2, plus 15%, 182.51 will be D3, plus 15%, 209.88 will be D4. So till here 15% per annum is the growth rate. Then children, as you know, from 5th year onwards the growth rate will become constant, so we can club it in P4. P4 will be equal to D5 upon KE minus G, correct? D5 upon KE minus G. Children, your D5 will be what? It will be D4, 209.88 plus the constant growth rate per annum, the whole divided by KE minus G, correct? KE minus the constant growth rate. Are you ready? What is that constant growth rate for eternity, for an indefinite period? They are saying it is 5% per annum. Okay, so I'll write down here plus 5% and minus 5%. So on the calci, children, I'll take 209, okay, 0.88 plus 5%. This, children, will come to 220.37. the whole divided by 15%. Okay, the whole divided by 15%. So on the calci 220.37, if I divide by 15%, I will get 1469.13. Okay, 1469.13 is, children, your P4. So I'll just write down here 1469.13. Everybody clear? Now let's put the discounting factors. Let's take 4 decimals. Okay, so 1 divided by 1.2 equal to, children, this is 0.8333. Then this is 0.6944, then this is 0.5787, and then last one, children, is 0.4823, and this also will be 0.4823, same discounting year, 4th year, right? And this will, children, give you the value of equity. So let's start, children. So on the calci 138 into 0.8333 m plus, this will give you 114.9954. Then 158.7 into 0.6944 will give you, if I press m plus here, 110.20128. 182.51 into 0.5787 m plus, this is 105.618537. Next is 209.88 into 0.4823 m plus, this is 101.225. okay, and then 1469.13 multiplied by 0.4823 m plus, this is 708.561. children, if I take MRC, this will come to 1140.6. that's it. Okay, 60174. I'm rounding it off to 1140.6, which means for this share I am ready to maximum pay 1140.6. This 1140.6 is the theoretical value, the intrinsic value of the share, and children, the actual value is 3122. Overvalued, overpriced, expensive, we will reject it. Everybody clear? Because I am ready to maximum pay 1140. You are asking me to pay 3122 for this share. You are overpriced and I will therefore reject you. Everybody understood till here? So that's what they're asking you. Find out the intrinsic value of the share, that is 1140, and state whether the shares are overpriced or underpriced. They are obviously overpriced, since the actual current market price of the share is greater than the intrinsic value, the theoretical value, the value that I am ready to max pay. So children, everybody understood this question. Now one last point, children. This question solution in ICAI module only, I will show it to you. I'll just show it to you. This is question number 6. Okay, yes, this is that question, children. But their answer of the intrinsic value comes to 2557.5. What is our answer coming to, children? Our answer is coming to 1140.6. Their answer is coming to 2557.5. Now you might feel, sir, what is this? Which one is right? Children, with all humility, let me tell you, this answer is wrong of ICAI here, because can you see here, till here everything is same that we have done. We have done it in a tabular form. They have put it in an equation. That's okay. Now here, children, this last point, if you see, I'll just share with you. 209.88 plus 5%, the whole upon 20% minus 5% is what we have to do. Now children, by mistake they did 20%, not minus 5%, they did minus 15%. Okay, actually this whole thing should have been 15%, as you can see here, but they by mistake did 20% minus 15% instead of doing 20% minus 5%. Everything else, children, is same. Okay, so that is this one error due to which this answer is coming different. Otherwise, children, don't worry, this answer of mine is perfect. Okay, don't worry about that. So with that, children, we complete the discussion to this particular practical question. Yes, question number 6. So I hope you understood the entire discussion of dividend decisions chapter revision as a whole, and I'm also hoping that you're enjoying this entire revision lecture series. We wish you all the best for your exams. See you. Take care. Bye bye.